there is more risk attached to buying a flat, because I think you're relinquishing some control of your investment to the management companies who overall very few do a very good job. I moved house myself last year and spent a decent chunk of money on the house, and it's a money pit. Do you have any idea how much double glazing is on a family home? Phenomenal. You thought I was going to say a word with an F then, but Andy, just me and you today. You've got a stinking cold and I've got backache. So this is going to be the most white middle-aged podcast that we've ever done in our 150
very monotone
something
one if you're
episodes. But stick around, because we're going to have an argument today. We've got 7 argument points. Ooh. So welcome to the Investors Corner podcast with me, Mike, and Andy. We've got 7 points that we're going to go through today, which are common questions, common things that an investor has to make decisions on when they're looking for an investment property and others. So, kicking off without further ado, flats versus houses. Which side of the fence you on?
Definitely houses for me, because flats, I think, are an absolute nightmare, especially to sell as well. No one wants to sell a leasehold property, do they? Everyone wants to go houses. But I think with the reason why I would always go houses is because I think there's a bigger potential for those houses for growing families or families that need to upsize or potentially downsize as well. And I think there's going to be better demand for those type of properties, see a better investment return for those type of properties if you can get into houses rather than flats. I think flats are great for first-time buyers looking to get on the housing market, but I think from an investment point of view, if you could have a family home within your portfolio, I think you're going to get better rents for those properties. B, capital growth on those properties I think will be a lot better than flats as well. Plus you've got the freehold for the houses. Like I said, flats with leaseholds and all of that sort of stuff, service charges, ground rent, all of that sort of stuff. To me, it's just not worth going into flats if you can. Obviously, avoid that. Where you sit, Mark?
I'll play devil's advocate.
Oh, here we go.
I've owned 3 flats as investments over my time, and I've made money on all 3. Right. Some more than others. And I think the key to buying flats is buying well. Not just buying a flat. I think you're quite right. For the amateur investor, you can buy a house and be very confident that it's going to go up in value, regardless, in the southeast. I'll caveat that because I don't know every part of the world. If you buy a house in the southeast, you're going to have to do really, really well to lose money on it, like really, really mess it up. Whereas a flat, you can lose money fast, particularly PD schemes, that kind of thing, office conversions, or properties that have been built with bad leases. So I feel like when I've bought flats, I've bought well. I've either bought where there's been an eye on share of freehold or 999-year leases or repossession. So I know that I'm buying in with built-in profit. The other thing I like about flats, which is a contentious issue because you mentioned service charges, is the lack of maintenance on it. I'm not a maintenance guy. I don't know my Phillips screwdriver from a flathead. I can just about put an IKEA Kallax unit together. So the fact I just have to deal with the 4 inside walls, some electric panel heaters and a kitchen from Howden's kind of suits me, to be completely honest. Whereas I moved house myself last year and spent a decent chunk of money on the house, and it's a money pit. Do you have any idea how much double glazing is on a family home? It's an absolute phenomenal, you thought I was going to say a word with an F, but I went with phenomenal amount of money, which quite often those bills don't rack up on a well purchased flat. I wouldn't buy conversions, I wouldn't buy old, I wouldn't buy low lease or that kind of thing unless there was a real bit of skin in the game for me. But for me, flats do have a time and a place. Absolutely. As a buyer, particularly a hands-off investor.
Absolutely, they do. It's just the thing with flats is, well, like you've just said. Now we've seen it time and time again, especially in the areas that we're in, with the newer build apartments or like the conversions that have gone down in price, and then people need to sell that property in order for their onward move, but they don't get the price that they paid for it.
Yeah.
3 or 4 years ago.
Yeah, paid $250 for it, selling it for $235. Exactly. I'll give you that.
Exactly. Totally, and then if you've got, the maintenance side of things, if you've got apartments and you've got a management company looking after that block of flats, and you pay those service charges, and they don't actually do anything within that building to, like any service or maintenance or anything like that. So when it comes to sell the property, the block of flats aren't in the best condition, or the communal areas aren't anyway, because it hasn't been kept, tidy and working properly. And you're paying all that money for that service, and nothing happens. So there's a few dangers with buying flats. But like you said, there is a place for them. We saw a great buy to let opportunity. Was it the last week or a couple of weeks ago? That was on the market.
Still on the market.
In
Wokingham.
In Wokingham.
That's a good example of where someone's probably going to lose money on that. And as an investor, you can buy in after rather than being the excited first time buyer or whatever. There's flats in the same building for like 290, 300, and this one's for sale for 250. Probably because it's ground floor, it needs a lick of paint. That's a couple of £1,000 worth of work, and it's £1,500 rental investment all day, decent lease. You're never going to meet the position is phenomenal for town centre. So I think you can buy well. I'll give you the point though on houses over flats. That's fair enough, because there is more risk attached. To buying a flat, because I think you're relinquishing some control of your investment to the management companies, who overall very few do a very good job.
Yeah, exactly. No, totally agree on that. Totally agree.
Interest only versus capital and repayment. So you're financing your buy to let with, 60-70% mortgage, for example. Mortgage rates are pretty good at the moment, 3.5% to 4%. On those rates, are you going interest only or capital repayment?
It's a tricky one. It depends on what my goal is. If I was an investor, I would probably go interest only if it was me. And the reason why I would do that is because it keeps the monthly payments down. I know my end goal is potentially to sell that property anyway and not keep it within my portfolio. I think if I've just done interest only, the capital appreciation of that property potentially might outweigh the payments anyway. So I'm still getting a return for my money. So goal dependent. Let's just say if my goal was to have a portfolio of 5 properties for the next 5 to 10 years, and then look to get rid of them all and go away and invest it in something else, then interest only for me is the way. If I had to, obviously keep those costs down and didn't have any, a lot of spare cash to one side, I just think that's the normal route that I would take, and what many investors potentially do.
Here's what I'm doing. I'm doing interest only as well. So I'm agreeing with you in a sense, but I'm overpaying on my interest only. I don't know why you would go on a capital repayment mortgage when you can do interest only and you can overpay by 10% a year. And when I say you can overpay by 10% a year, if you've got a £250,000 mortgage, you can overpay your mortgage by up to £25,000 a year without penalty. So again, like you, if I'm running a small portfolio, there are times when you might have 2 open empty at the same time, or you have to go and replace a kitchen or something expensive. It gives you that flexibility to drop your payments down to the minimum. But while I've got all 5 or whatever, all functioning, all rented, then I'm going to overpay by a certain amount. So I might set it at the repayment amount, but it gives me the flexibility to drop it at a week's notice if I want to.
Yeah, I don't
give myself that kind of flexibility. I would rather maybe pay down half of those mortgages whilst I own them before doing that kind of same disposing thing, or get to the point in 20 years' time, having owned those 5 properties, where if you've paid off half the capital, the rest of the capital looks like pocket change because of inflation.
Yeah.
Look at the inflation over the last couple of years. You know, if you'd have said £100,000 5 years ago, it sounds like a lot of money. £100,000 now doesn't get you too far.
No, it's not a lot nowadays.
So if you bought a buy-to-let 10 years ago at £180,000-200,000 with £100,000 debt, well, that might look like a lot then. Now it doesn't look like an awful lot of money. So you use that inflation to your benefit, I guess. So 20 years' time, if you've paid off half of it, the rest of it can just maybe be paid off with a redundancy or a pension drawdown or savings or inheritance, that kind of thing, to just totally see you away and have them debt free for retirement if you're going to keep them, or sell one and pay the rest of them off.
I don't hear a lot of people about making that overpayments like you've just explained, but when you explain it does make sense, doesn't it? Because it's like you can do it anytime you want. You're not potentially
I do it with my own home, to be completely honest, and I don't see why other people don't. I take the minimum payment that I need to make, that is on repayment, but on a minimum repayment, and I overpay it every month. I like the Halifax app. It tells you how much interest you paid that month. I like seeing it drop by a couple of quid a month.
Yeah, it's nice.
I mean,
nice.
I shouldn't be checking it all that time.
No.
It's probably really unhealthy, but we move on. Old versus new. Next argument. Where are you putting your money? Old versus new.
I mean, new builds. So my last 2 properties have been new builds, and the reason why
I had some swearing last week.
Yeah, I mean, it's and new builds are great. 10 years later, they're not great, because that's when all of the problems seem to arise after the guarantees run out on the property, and then you need to start paying some costly money to put things right. And the reason why I did new builds is because you're moving into somewhere that's in modern condition, looks great, newly built as well, so you would think that there would be less problems. But I think the thing with new builds is they're chucking them up. I mean, they're throwing them up quickly. And if you look at the materials that are used now to build new properties, the quality is just not there. Unless you've got an amazing house builder, and they are out there.
I was going to say, would you pay a premium on a buy-to-let for a Berkeley, for example?
Yeah.
Because when I go into a Berkeley new build, I can feel the difference.
Yeah, you can feel
to another national house builder that I won't mention.
You can feel the quality. I would definitely overpay for something like that. I'll pay a premium for something like that.
Because you're not going to get a massive premium on the rent in comparison. But
yeah, I think as a
5 years down the line, you make
an investment point of view, I think you're a lot safer with something like that compared to just a normal, house builder that's in the country. So, yeah, new builds are great because you get that initial quality. Everything's done. You don't need to worry about anything. But further on down the line, old houses have their issues as well, but I think the build of older houses compared to new builds are a lot better quality and a lot better materials that were used, and I just think with older houses you got the potential to put your own stamp on it. You potentially got the potential to extend on it as well. With new build properties, you don't really see a lot of them being extended. There's not really a lot that you can do with them, apart from potentially maybe go up in the loft. But apart from that, that's all you can do. And everything's quite compact. They're in estates. The estates are great once they're created. Again, further on down the line, they could go the wrong way, i.e. kids running about.
You're having an argument
mess
with yourself here.
Yeah, I am.
It's
only because I do want to move, and I'm trying to make it work in my mind that I need to move. But yeah, there's some of the things why for my next house purchase, although the previous 2 have been new builds, I won't be buying a new build again because of further complications.
Unless you got the premium to spend. Yeah. So here's mine on just thinking pure investor. I would go down the middle. So I've just done like 2 sitting on the fences in a row of saying interest only with a bit of capital repayment, and I'm going to say not new build but not old either. I don't like Victorian houses. I know that's quite contentious, but don't like them. Loads of maintenance. Even if you get a survey, you're going to find stuff, gremlins behind the walls. And brand new, I don't think you get great value for money, like you for a lot of the reasons that you just said. I like it when the shine has just come off, and it means that you don't have to do kitchens and bathrooms. You've still got 10, 15 years of a decent kitchen and bathroom, but that means the premium's also dropped off it as well. So personally, I when I moved for my last 2 houses that I've bought have been 90s houses, because they've got that potential to extend or improve on, but they're established at the same time. So they're somewhere down the middle is my sweet spot. And I've been the same with investments as well. Never bought a new build, never bought a really old one either, because I don't feel like you get value either end. But I think you get much better value in something where the windows are already good. You're not looking at horrible wooden windows, but you're looking at decent quality UPVC that will stand the test of time. I'm not going to have to rip them out on day one kind of age. So again, I'm getting splinters.
I think that the thing with new builds as well is that, you know, it's not always a bad investment to make, because we've done a previous podcast where Ian was talking about potentially approaching the developer, buying something off plan and doing it
you can
it
buy
that
up
way.
through the development, like you said. If you buy early in the phases,
you potentially get a good deal. You get, you know, incentives from house builders as well, where, you know, saw one the other day that they pay you stamp duty and all of that sort of stuff. So it does entice you in to do it, and it can work out if you can get a good deal at the early stage. But we've seen with new build properties, especially where we are, that they've sort of had the same value for the last 3, 4, 5 years, haven't gone up by much. And then you look at an older type of property, not old, but older type of property, where you've just got more capital appreciation that are happening on those types, because I think people would rather something like that, where they could have it as a project house and put their own stamp on it, rather than move in and not be able to do anything apart from a bit of repainting and a bit of furnishings here and there, and then that's it.
Right, classic argument for investors: capital growth or yield.
Yeah,
you can't. It's difficult to get both.
Yeah,
and this is quite often a north-south argument as well.
Yeah, I think again, it all comes down to the goal, doesn't it? It's like, if it was me as an investor, I'd be looking at the capital growth, because I would think that's what I would focus on as my bigger return over time. But we've seen with house prices recently that they haven't gone up as much as what you'd expect. You know, they've increased slightly, but not by massive percentages. Average yields where we are at now are about 5%. So again, nothing amazing. But I just think for me, it would come down to the capital growth, because my goal would be that I'd want to exit at some time. So I've got to make sure that those investments over time have the capital appreciation and the capital growth to get.
Depends if you're talking, if this is if you're trying to make your money now or if you're trying to make your money later, doesn't it?
Yeah,
that's what it comes down to for me. And yield now is student lets, HMOs, high risk as such, high workload in comparison to family units, but it can be your full-time job rather than a reasonably hands-off investment. You said houses means capital growth, not yield, doesn't it?
Yeah,
realistically, because you've got a higher purchase cost into it. I've got an argument for flats, which gives me an argument for yield as well, because I can get 7% in the southeast on a flat, gross, before obviously all the costs. Remains to be seen, 30th of October. Landlord
D-Day.
Taxes, what's going to happen? What can you offset? What won't you be able to offset? Where are they going to hit you? You're going to get hit. if you're a middle-aged landlord, you're going to get hit. How is it going to hit you? And then that might answer your capital growth versus yield, because if they slam up capital gains to 55%, you might not be less excited about capital growth, because you ain't going to see much of it.
Yeah, true.
So there's a bit of a future with that, and it goes back to me again with the flats versus houses, is buy smart, and you can have an element of both, because if you buy something that instantly grows in value a little bit, and whether that be the sort of Peter Lucarinas version of buy in and then improve the property, or buying a repossession or a refurb or something like that where you can instantly add value. Sometimes it's just a seller that's just desperate to get going, and we're a couple of weeks out from October now. If you can close on a sale before Christmas, quite often someone will give you a healthy discount just for the sake of it. You can have a little bit of both. You can tune it, but for me, because I'm of working age and I'm not looking to do this as a full-time job, I tend to agree with you. It's capital growth over yield. Unless you're going to do it full-time and really, really go at it, then adding a couple of percent or a couple of £100 here and there doesn't really move the dial. No. But if I can make 100k on a property,
that's what you want.
It's a massive difference from my retirement pot.
Yeah.
Hands on or hands off? I almost hinted at it in the last bit there, didn't I? I didn't read the next question.
Hands off all the way. For me, if we're talking from a buy-to-let point of view and we're going to rent out properties, it's just I would always have an agent there that does everything for me, because I haven't got the time to deal with maintenance inquiries, rent demands, midnight phone call from a tenant to say that their boiler's not working.
You're going to say locked out on a Friday night.
Yeah, locked out on a Friday night. Yeah, and go through that pain. But yeah, it's just for me, I don't want that hassle. And if I have to pay an agent 10% of the rent to fully manage my property on a monthly basis, I don't care, because I know that I'm not being hassled. Compliance bits are normally covered by an agent anyway. All right, I've got some responsibilities, but at least I've got the agent there guiding me in the right way and helping me with that if I need to do anything. They look after gas safety expiry dates, all of that sort of stuff. And I just think it's a small cost to pay to use an agent to deal with all of that for me whilst I get on with my life, forget about it. And that's sort of it. That's what my goal and outlook on it is.
So you're willing to sacrifice some performance for some free time. And I guess that comes with time of life and all that kind of thing. You want to spend the weekends with your kids, or you want to spend the weekend doing repairs or doing viewings. That's I guess the question, isn't it?
Yeah.
And everyone will have a different appetite for that. If you've just sold your business and you've got money in the bank, maybe this becomes your business.
Yeah.
And becomes a bit of a hobby alongside golf.
Yeah.
But if you're still of working age, most people would tend to agree.
Yeah.
I would say you're looking for as hands off as possible, and that ties in with your houses and your modern and your capital growth kind of machine, doesn't it?
Yeah.
This is a budget one. Limited company versus personal name.
A lot more people are going down the limited company route.
Yeah.
From what I can see, what the articles that I read, the things that I hear, that tends to be a big shift at the moment by putting it into the limited company. Obviously, it's got its tax benefits doing that and other things as well, but you still need to meet certain criteria to make that happen. But there's a lot of people more focused now on the limited company route.
Is that just people who own multiple properties?
Yeah, I think so. because obviously for those people that do have multiple properties, it'll be more beneficial for them to do that. If you've just got a landlord that's got one property, couldn't really, potentially go down the limited company route and put your assets into that. I don't know. I'm not an accountant. Don't take my advice. Little disclaimer there. But yeah, I think the people that I've been speaking to and what I've heard are the portfolio landlords that are going down that route. Some have got 3-4 properties, so small portfolio landlords. But there is a big sort of buzz around doing that right now, as in before you didn't really hear about it.
Yeah.
But now you do.
Wasn't worth the hassle when you could offset all of your finance costs and this, that and the other, which obviously you can't now, as a higher rate taxpayer owning something in your own name.
And
so
things will probably get a lot tighter in the future as well, with new things coming in. So yeah, I think that's another reason why people are looking down that route.
Trying to replicate what the big financiers and banks who are going to own tens of thousands of properties over the next few years, trying to replicate that model in a small way to see the same benefits. We will see whether this is the UK government's biggest bait and switch policy yet.
Yeah,
time will tell.
Time will definitely
put
tell.
your bets on. Comment in the comments below. Give us something new to think about. Last and not least, this is straight out of your playbook. This one, property versus stocks.
We've had a lot of talk
We've done
on
the
this
50k last week, didn't we? We did the 50k. Where'd you put your money?
We've had
episode.
we've had a lot
which
of
led
talk.
to a bit of research.
Bit of research, but I think it's a difficult one because with property, you've obviously got an asset there that grows over time, which is sort of like stocks. But I think it's just more exciting if you're investing in stocks. I don't know why. I just feel like I want to be able to look at my phone and see what all of the stock shares are doing, take money from one stock, put it into another stock. Very time consuming doing that, but I think that you get the exciting part from it. And I think if you're making investments and you're putting your money into something, I think that you need to be excited about it. It's like if I had a double glazing window salesman and someone that was selling property, I would assume that the guy selling property is having a better time than the guy selling double glazing window.
Well, I don't know. I had a quote on windows the other day, and I think they did pretty well.
Well, I'm taking the property guy. He's more excited about doing that because there's a lot more stuff going on.
Yeah.
And there's, seeing nice houses, dealing with different types of clients, getting that, good commission packages for selling, etc., etc. So they probably get more excited about that. And for me, I'd get more excited about stocks and shares. Not to say that there's no place for property or property's had its time in investment, because if you look at what property has had thrown at it over years and years and years, it's always come out the other end correctly,
worth more than it started,
and it's worth more. Stocks and shares, massive risk because they can dip, and they can dip quite significantly. We saw that, take an example of do you remember when Ronaldo put there was a Coke bottle on the table and he took it away and their stocks fell down by 30% or something stupid.
Yeah, it was quite an event, wasn't it? Ronaldo drinks water.
Yeah,
amazing.
But we saw the share price go down significantly. So, and that was just one moment that one guy.
But that, if you're an investor, that's where you should have bought Coke.
Yeah. As soon as the share price dips, you should
perfect opportunity.
Yeah, because now it's back up to where it was. It's just
when Netflix dumped Russia, Netflix dropped something like 23% overnight. That was the time to buy because they're going to bring that back at some point, and they're going to literally bring 1 million subscribers back overnight. I'm going to go into bat on property then, because that's what I've invested in overwhelmingly over the years. Firstly, because I know it and understand it. I do love the being able to touch, feel and see it the fact it's
Yeah.
real and not an on paper investment. And that's what I know a lot of my landlords love. And the other thing is leveraging. Is if I've got 50k, I can buy 50k's worth of stocks. Whereas if I've got 50k, I can go out and buy a 250,000 pound property and use the bank's money to make me money. And so I see it in on a slightly different thing. I can make a bigger investment in property than I can by just going out and putting my my money into either picking stocks or into a fund. And I don't have I do read the news, but for some reason I know what's going to happen in the stock market, but I never commit. I've picked these things happening. I picked Rightmove jumping at the start of this year when they had it on a recommendation to sell. I picked Rightmove, Netflix going up when they dumped Russia, and I was right. Never invested in them though. So don't take my advice, because I can't follow through. But I have done when I've seen a property, I've been able to make that direct decision on it, because I feel like if I buy a buy to let, the value can still go down to zero and it still be a good buy to let, because it's producing on a monthly basis. I feel like that seesaw of benefits will always work for me. And I guess you could do that with stocks as well, with dividends.
Yeah.
Value goes to zero, you're still getting your cracking dividends on it. Well, a dividend stock is as good as anything else.
Yeah.
But I'm batting for property because I can borrow the bank's money and I can make money on someone else's, which I always thought was good.
And I suppose with property, you sort of know what you're getting. So you know whether it's a good investment to make, you know the type of property that you want, you know what can sell good, you know what can let out at the correct figure. Stocks and shares.
Buy Tesla shares, you don't know if Elon Musk's head's going to fall off.
Yeah, you don't know what he's going to do. But it's the same with, AI stocks and shares, tech stocks and shares. You probably don't know enough about that type of field on what is going to happen, what they've got in the pipeline, what are they going to release, how could that affect everyone in the world? Are people going to buy into it? So it's all of the unknown.
In which case you mitigate your risk and then you water down the benefits, because it's really easy to say I would have bought shares in X which went up by 1,000%.
Yeah.
But realistically, no fund ever does that.
No.
They're always hedged with all sorts of safer bets, just in case the really risky one doesn't come off. So fair play if you're out there and you were the one who just stuck it all on red in the stock market and made a load of money. But I imagine for every one that does, there's 10 that loses. But we've said it can happen in property as well if you make the wrong purchase. I just feel like you say, there's history in something, and a growing population means that you have a level of guarantee with a growing population that the house prices are going to be protected with everything that's been thrown at the housing market over the last 4 years. Even going back, I've been working in the industry since 2005, seen 2008 through, seen COVID through, seen the drop from COVID through. I've seen all the naysayers and the doom mongers away, and I've climbed the housing ladder personally, done the investment thing, and you just got to look at the rich list. I can't look past the rich list and see that people who make money in anything, a huge proportion of their net worth goes into property one way or another.
Yeah. Well, there's an article the other day that came through and said that, I don't know, it's like 90% of the world's richest people all have real estate investments.
Yeah.
So it's obviously a place to put your money, right? Because I want to learn from those people.
Yeah.
I want a bit of what they're doing.
You don't have to reinvent a wheel. You just look at what other successful people are doing, and there will be a pattern. There's always one, isn't there? So that's Andy and I's 7 arguments of the week for middle-aged men in pain. If there's any others, or you disagree, or that you feel like we've missed a point entirely on today's show, stick it in the comments, and we'll go back over it for sure. Till next week, catch you then.
Thank you.